Welcome to Card Table Commentary. I'm your host, Seymour Peterson. This is installment number 9 about what I call the financialization of the economy. Starting in 1971, when the last link between gold and the dollar was severed, the economy became increasingly financialized. That is, more resources and more employees were devoted to managing financial transactions of all kinds. The financialization attracted the best and brightest of the new people coming out of college, and a great amount of resources, and it became a big part of the economy, but it was sort of independent from everything else, and it grew at its own rate, and basically the people that were involved in it seemed to be compensated at a higher rate than the rest of the people. Without any real discipline, the rates of foreign exchange and interest rates began to fluctuate wildly and unpredictably. This started a whole new industry of people that were in business to control financial risks. In the middle 70s, the financial future markets were put into place, and you could buy a futures contract on interest rates, on foreign exchange rates. You could even buy one on the value of bonds or the value of the S&P 500. This created a burgeoning industry, and it provided employment for a lot of analysts and managers and traders who claimed to be able to control financial risks. From the 80s forward, interest rates began a long and steady decline. As a result, bond prices went up, and the price to earning ratios accorded to stocks went up. So the stock market had enjoyed steady gains during this period. This was the era of mutual fund investing. And the funds grew at a rapid rate, and they in turn employed a lot more analysts and managers and traders. The successful managers of the period, like Peter Lynch and Bill Gross, became national celebrities. Lou Rukeyser's Wall Street Week became must-viewing. The established high-commission brokers like Merrill Lynch fell out of favor, and they were replaced by an army of boutique investment and wealth management operations, what you could find on any street corner. Declining and stable interest rates created a new market for leveraging nearly everything. Corporations rushed to develop more debt-heavy capital structures. And of course, more opportunities were created for analysts and managers and traders and deal makers. Of course, highly leveraged strategies like this increase risk, but corporate owners and investors weren't disturbed by this because they felt that the Federal Reserve was endorsing and supporting this kind of policy. And it really was. This was the concept they called the Greenspan put. In a way, the Fed was being held hostage by these highly leveraged companies, and they couldn't not support them for fear of a major financial crisis. And so you could say that they were forced to accommodate them because they were too leveraged to fail. New financial schemes proliferated. There were hedge funds, there was venture capital, there was private equity, there were leveraged buyouts, there were high yield bonds, and the ETFs. The total assets held by people in the U.S. actually increased from $10 trillion to $50 trillion from the beginning of the 80s to the end of the 90s. And a big portion of these assets were financial assets. And the high volume of these, believe me, $1 trillion is a lot. And the financial sector lives off of taking a little bit off of every transaction. There'll be a management fee, there'll be a custodian fee, there'll be underwriting fees plus a percent of the profits. This was easy money to be made in this sector, and especially in comparison to the struggles that the rest of the economy was having with globalization. The financial people kind of had a thing all to themselves, and the best graduates from the best schools started going into investment banking and finance as opposed to the professions or management that might have used to attracted them. It actually created an elite class of these financial people that were well compensated and increasingly separated themselves from the rest of the economy. It's debatable whether any of these financial shenanigans really benefited the economy in general. Paul Volcker, who I feel is one of the few that survived this era with his integrity intact, once said, show me one shred of evidence that financial innovation has added to growth in the economy. Just one shred of evidence. In the next installment, we're going to go into the 2000s, and we'll start to talk about when the new economics really comes into play.